Good morning, ladies and gentlemen. Well, 91 to end up the week on the wrist dial, so everything is very strong. There's not a lot of danger that we will give a sell signal anytime soon, but this is a very, very slow system, and therefore that doesn't mean very much. I will explain to you why I have thought for a long time that this is going to be the Crux week. And now that we have definition in the S&Ps, it's going to be pretty easy to identify if we're going to have a change of trend in the next few days. With that said, let's first examine what the bonds are saying. The yield curve has been very quiet for a number of days now. Certainly 2 or 3 weeks we have in the 2s10s, with which this is a chart of. We have the very, very slow retracement back down towards the 126, 127 area. If we get to see that, that will be a wonderful area, I think, to play for the upside. I just cannot get bullish of the bonds, but the yield curve is just telling me that the timing is not yet to do whatever it is that we need to do. And I'm sure that it'll give us the timing very, very soon. 2s10s, if we see it anywhere near 127, I think it'll be a great opportunity to look for a further steepening. And just like in the 2s10s, 5s30s, which I think is far more important, is doing exactly as I thought it would do, i.e. it's trading between 154 and 140 basis points, just doing absolutely nothing. We changed the week, the net change in the week was like 1 basis point, completely irrelevant. So whichever part of the yield curve we look at, and this is now the 10s, 30s, exactly the same. We can't break into the higher range, and we keep on hitting our head against the 64, 65 basis points in 10s, 30s, indicating that we're still in the same range as we have been since July of last year, between 64 and 80, 81. That being said, I think that the odds are constantly increasing that we have another accident in bonds, and I will show you why. This is a chart of Jeff Gundlach's favorite indicator, which is a ratio of gold and copper. And as you can see, last week it made a new low on the move. You can see how far it's come. This is a massive move. And we are coming down to the lowest indicators that we've ever had, basically spikes down in 2012 and 2014. This to me is an indicator of inflation expectations and activity expectations. And while it's doing this and making constantly new lows, the odds are always increasing that the bonds will have another move higher. Having said that, there is nothing on the individual charts, but we will have a look at those now and see what the copper-gold ratio is actually forecasting for bonds over the next few months. If we have a look at, this is a chart of the 30 years, this is yields, and this is TLT. You can see that basically copper bond is indicating prices around here. This is where we were when we made those lows in copper bond in 2013 and 2012. So it's indicating that we will at some stage go back towards between 115 and 101 in TLT. This obviously, this move down is the primary move, and this is the consolidation. And the risk is increasing that at some stage we go down at least towards 127. I just cannot get bullish of bonds. If we have a look at what the rates are doing themselves, this is quite obviously a corrective pattern. It's obvious to me that at some stage we will test again this 250 level in 30s. And if we look at the 10-year note, it's much more likely. I have no idea whether we trade 139 first, but 2s10s would say that if we see 139 and therefore that 127 level in 2s10s, the risk reward is all on the upside, and that we trade these levels above 185 to 200 basis points. The risk in bonds is all on the upside, and the further we correct here, the risk reward becomes better. The same story about risk reward getting better is it is shown in all European bonds. This is a chart of the bubble, the 5-year, and as you can see, every week it keeps on closing slightly higher. If I switch this to a weekly chart, you can see how this is now the 4th week that it's going up. It's going up minutely, but that to me suggests that the market at some stage, maybe in 2, 3, 4 weeks time, will be ready to start breaking these levels and breaking out to a much less negative range. I am convinced that sometime this year we will see the whole of the German curve go towards 0. And if we have a look at the 10-year, which is much more likely to be the one that gets hit rather than the 5-year at the moment, you can see how we are really so close to this minus 22 level. This is on a daily chart, but if we put it on a weekly level, you can see how we are so close to breaking out. And I think any kind of move above minus 17 is going to indicate that we are starting a much stronger leg up, one which is going to take us all the way into positive territory. I think the risk reward in the whole of Europe is very, very much to the upside in terms of yields. If we have a look at the 10-year against Germany, I think what could easily happen, as I've told you before, is that we go down to this 175 basis point level and that we stick to it, and that then Bunds and US go up together in yield to the levels that I've mentioned. I think that if we see 2 in 10-year notes, we could easily see 20-25 basis points positive in Germany. And the ones that I'm also looking at are the BTPs, and that is showing the similar pattern. You can see that if we start breaking this 83 yield, we could go quite a bit higher. We could go all the way to 110, 115 basis points. So that's another 20 basis points, 25 basis points on the upside in Italian bonds. And what would give us in Italy, Germany? Well, that would give us these levels up here around 110, 115. So I think that the risk reward in all of these markets in fixed income is very much for higher yields. As the differentials in interest rates between the US and the European bonds come in, the dollar is weakening. I just cannot see much upside for the dollar. It's basically done a perfect retracement up to the underside of the trend line, and it's basically been one-way traffic ever since the dollar is getting sold. As I said, Q1 we're now in Q2. Q1 would be neutral, Q2 would be weak, and I think Q3 is going to be very weak. I really don't think that there's any need to even think about buying dollars until we reach the 88.5 level, and I think we will be there within a few weeks. If we have a look at the euro, we can see that actually we closed at a level which is only about 1% lower than the highest weekly close that we've ever had since this move started. This to me indicates that the path of least resistance is very much to the upside, and I'm sure that 123 to 125 will trade at some stage over the next few months. On a weeklies, we have a wonderful near buy signal in the MACD. I'm sure over the course of the next couple of weeks that will materialize, and then we will touch the 125 level. That is why I am it's all coming together. The differential going down towards 175, the fact that I really don't see that the 10-year can get much better, and in that case I have to be bearish on the bonds. If I'm bearish on the bonds, I have to be bearish on everything, and that to me tells me that the path of least resistance in fixed income is still higher. I just can't see an indicator like the copper against gold being completely wrong. It's just never happened as far as I know, and really I have to respect it and have to think that at some stage the path of least resistance is a resumption of higher yields and a lower dollar, and that is really what I'm seeing in the charts. It is interesting to note that in a week when the dollar was weak and bonds did absolutely nothing, gold closed completely unchanged. It had having broken out on the dailies, I will enlarge the daily chart, having broken out above 1764, it had a chance to go higher. It tried for a couple of days. Let's enlarge this so you can see exactly what happened. 1, 2, 3, 4, 5, closed. It had a chance to go up, failed, came back and closed completely unchanged. It had every chance to go higher and it didn't take it. Mind you, it didn't break the 1764 either, but I think the odds are constantly increasing that even a lower dollar is not helping gold at all. And if that is the case, I think that when interest rates start going back up, when bond yields start going back up, gold is going to get absolutely killed. To me, there is no reason to own gold as long as I'm expecting high yields in Germany, Europe in general, and in the States. There is very, very little upside to be held in gold. Last week I showed you a chart of DBC, and here we're breaking out and going towards this 1841 level. That's been so pivotal. I think we'll get there in the next couple of weeks. Absolutely no reason not to think that that is happening. And that's another reason why I just cannot be bullish of fixed income. This is now a chart of a weekly chart of copper, and as you can see, it's just making new highs. We are likely to go towards 5 at some stage. The grains are on fire. DBC is going up. Its copper is going higher towards 5. And don't forget that these are levels last seen in 2011, 2012, when the economy was, doing extremely well coming out of recession. If that is the case now, there is absolutely no reason to expect bond yields to do anything but go higher. onto risk. And, as I've said for a couple of weeks now at least, I think there is very little chance that we see a high until we see these big earnings, and they're all coming this week. Apple, Facebook, Google, Amazon, they're all reporting this week. So this week is going to be absolutely pivotal. And the beauty of last week is that we now have very good definition. This is the 195-minute chart, which I love, and I don't hedge my portfolio until markets close below levels. You can see how well this 41.29 level worked last week. We never closed below it, not a single time. And every test was rejected and we went up. So what happened on Friday is that everybody got stopped out of their short positions. But do I think that the market can keep on going higher? I think it's going to be a question of buy the rumor, sell the news. The rumor was down here that earnings were going to be on fire, and the news is up here that they are on fire. I think that the likelihood that every single company will not surpass the earning expectations is quite low. And I think earnings are going to be very, very good indeed. But I think it's also going to be, in the short term, a question of sell the news. I don't think that the market will go strongly higher. And I think that the likelihood is actually that we come back and retest this 41.29 level on the back of earnings. If we hold that kind of level, or even if we hold 40.68, that will be a very, very bullish sign for the summer. I think the expectations are going to start building up again for better earnings towards year end, for certainly towards September, October. And if that happens, if that's all we manage to do on the downside, I'm looking for probably another at least 10% on the upside. From this level, that would take us to 4,500. So this is the very important level next week. I think any close above 41.29 in SPX next week takes us down to 40.68 without any problems. But, one day at a time. I have absolutely I'm always long because I have my portfolio. And I'm in no hurry to hedge anything until we start breaking important levels. The very fact that we can't break or even test 40.78 to me continues to be bullish, and tells me that the likelihood of an exhaustion higher is still relatively good. If we look at the weeklies, has this market done anything wrong? No. It's doing absolutely nothing wrong. It had a week of wonderful, stopping everybody out, but closed absolutely unchanged. To me, that is not the sign of a weak market. The sign of a weak market will be when we go up on the earnings and then come right back because people are selling the news. That is what I'm looking for to give me an indication of the next 200, 300 points. Until I see that, I see absolutely no reason to short this ahead of the market telling you that it's done enough. If we look at NQ, we get the same wonderful definition as we have in the S&Ps. 13,700 on a daily basis is going to be absolutely key. Unless and until we close below there is absolutely no reason to think that we're going anywhere but higher. I think it's quite likely that we have at least this much of an extension up that takes us to around the 14,400 area. And after that we see. But whether we look at it on the daily or the 195-minute, we see the same wonderful definition around the 13,700 area. Only a close below 13,700 is going to indicate to me that there is any kind of weakness here. 13,717 to be precise, and that is actually the extension of the 100% extension of the ABC up. So, you know, it's there. I think it's more likely to test the upside the first couple of days of next week. And then we get the earnings and the true move will reveal itself. I'm constantly monitoring the spreads against tech, because tech is such an important part of the States, such an important sector. You can see what we have done here in this is the Qs against the SPY, and to me the worrying part is the fact that we are rolling over on the averages. We could easily have a weakening of the Qs against the SPY, and that would naturally be bad for the whole market. That's why I'm saying this is the Crux week, because if we get a buy the rumor, sell the fact of the higher earnings in tech, that could be quite problematic. And we have our level in 13,717 on the NQs, and we have our level in the S&Ps, but a move down in the Qs against SPY would accelerate and provide a very large move in the Qs, and that would give us quite a large move in everything else, the SPY as well. That is why it's so pivotal to have a look at this ratio spread, and I'm very aware of what the important levels are, and if we start breaking them, it could be quite a big move, and naturally I will keep you updated. These are the ratio spreads between EEM and the various other markets. This is Japan. As you can see, I showed you this last week, flattish. It really needs to start breaking above these levels for it to become bullish. I don't think it's going to happen in the next couple of weeks. You've seen the situation, how panicky the situation is in India and Brazil because of the COVID situation. But the very fact that EEM managed an uptick, this is against Germany, an uptick despite the really horrendous news about COVID in the emerging markets, tells me that the path of least resistance is still up for EEM. And if the path, and this is now the very important one against the States, and even against the States we managed a slight uptick. Now it's come on the back of this very important level. If we start now going up 5-7%, this could literally mean that we are on the cusp of a rotation out of the US. And since this is the Crux week, I think this relationship between EM and the SPY is going to be absolutely key. If we look at what EEM is doing, it's doing still nothing wrong and nothing right. Until it closes below 52.08 and especially 50.23, it's doing absolutely nothing wrong. This is a consolidation, this is a normal retracement. And until it closes above 55.83, it's doing nothing right. Still in no man's land, still a sort of either sell between 52 and 50 puts, or buy a call spread and just leave it as I have done for the past. I mean, I used to, I sold for many weeks this put spread. I got so fed up with not getting exercised that I bought the call spread, as you know. I think next week is going to tell the tale, both for EEM on a spread against SPY, and I think that's very important because given the fact that we couldn't go down on such bad news, I think the risk reward turns up in EEM. And if this is a crux week for NQ and all the big earnings, I think it's a crux week for the spread relationship between EEM and SPY, and it could be the start of the rotation out of the US into EM. I'm not going to anticipate it, but I'm very aware that there is that possibility. Finally, a word about volatility, and that has actually given us definition as well. You can see how we just could not sustain the very important 20 level. If this will be another signal. If we manage to close above 20, I think that then we are in trouble in the States. But until and unless that happens, the path of least resistance is still down towards 15. And only there will I be prepared to hedge out of trend, as it were. So we have very, very good definition. That's what last week gave us in S&Ps, in the EEM spread against the S&Ps, in NQs, and now also in volatility. We have wonderful definition in everything, so we don't need to anticipate, we can react. In the summary sheet, I've updated certain things. I think 127 basis points if seen 2s 10s is a wonderful risk reward for higher. I doubt we'll see it. Nothing going on in the 5s 30s. Still, I think any break of 154 is going to be very problematic for the market and will indicate higher yields for 30s. DXY, I've changed the levels. Now 9101 is resistance, but it's very weak. But there really is not a lot of support until 9018 in DXY, and then after that we're looking for 8850. Gold, I think that if we now break 1765, we'll see 1725 at the very least. And still, it just cannot do anything above 1810, 1830. We would have to see a much weaker dollar and also some help from bonds for that level to be broken. Now, SPX and NQ, we have wonderful definition. As I showed you, 41.29 is going to be a very important level, and 13,017 really, really important in NQ. So we have our definitions, and that's why we've put VIX down here as well. We want VIX to confirm on the, if above 20.05 if these levels start getting broken. If we get a confirmation between these and the VIX, then things are going to hell in a handbasket. I mean, at least for 50, 70 points on the SPX. But I really wouldn't anticipate it. There is not a lot of reason for it. I will only play the shorting an extreme move to the upside if it's on the back of the earnings, because I think the odds of a buy the rumor, sell the fact on the FANG earnings are quite high. But I'm still looking for higher yields in everything, including Italy, Germany, France, and the spreads. So those are the very, very important levels, and we shall trade them accordingly. Thank you very much indeed. Have a wonderful weekend, and we chew on Monday.